Welcome to Buy, Hold, Sell. I'm Ben Clark, and joining me today we've got Vince Pezzullo from Perpetual and Adam Alexander from Evans and Partners. And we're going to start off doing a deep dive into Woolworths and Wesfarmers, two $40 billion market cap giants, but looking to take pretty different paths going forward from here. We'll start with a bit of an overview of the businesses. Vince, what do you see as the key differences between the two companies now, and how do you factor that in when you're trying to value what you think these companies are worth?
Well, actually, both of them were quasi-conglomerates, really. Woolworths obviously had a lot more heavier weighting to supermarkets, but if you look at what it's done in the last 3 years, which the management should be commended for, it's actually shrunk back towards being a supermarket business again, which is its core franchise.
Okay. And Adam, have you got anything to add to that? Because Wesfarmers seems to be taking quite a different path. What are your thoughts there?
Yeah, I think you've got to look at Wesfarmers as a manager of capital, and Rob Scott's done a really good job over the past few years in selling businesses, sold resources, sold Coles, and getting back to the core franchise. And so when you look at the two now, probably compare Bunnings to Woolworths. And when we assess the businesses, it's sort of looking at the fortunes of what could happen to Woolworths versus Bunnings, I think, going forward.
Yeah, because both these companies are taking some big divestments, some big acquisitions in recent times. Do you think there's one that stands out in terms of strategy going forward that you prefer, or you've got a house view that you like?
Yeah, I think probably Bunnings has, Wesfarmers has a little bit more optionality. So when you look at their biggest business, it's Bunnings. They're starting to move into the trade sector. Yeah. They're also moving online. And then if you take a look at the Wesfarmers group as a whole, they've got some balance sheet power now. So optionality to go out and buy some new assets. Yeah. They've deployed about $1 billion into Catch and Kidman resources, and they've still got plenty to go there.
Yeah, and looking to deploy more, Vince. The Linus bid is still on the table, but it's looking less and less likely. It seems an interesting move from Wesfarmers to be branching out in a different area.
I have a slightly different view than Adam on this. I'm a bit, it was a bit more of a stalwart type stock, Wesfarmers, and if you think about where Woolies is going back to, as I said, to the core, and they've liberated the balance sheet, a lot of excess capital now. They're going to spin off Endeavour Drinks Group again. I think another capital return come from there, but they're going back to where their highest returning business is, which is known and a pretty good industry structure as well. Yeah. With Wesfarmers, it's commendable they got rid of Coles, etc., and they're moving to new areas, but there is that risk about deploying a balance sheet into new industries where they don't have a history of it yet. So I think if you think about a risk-return relationship, given the multiples are quite similar, I think Woolworths has got a lower risk for the sort of return you can get. So that's how we sort of think about it going forward. Okay.
Have you had a thought about Endeavour yet? There's Demerger coming. Demergers have typically been pretty good places to be, maybe not for the first 6 months or so, but you started to think about whether you'd like to be in that business or the ESG sort of things are an issue?
Well, fortunately, we run a couple of funds so that we do have an ESG type fund which can't obviously participate in the Endeavour Drinks component. But actually, fortunately, Woolworths can actually now be probably invested in for the ESG fund once that happens. Yeah. Look, we actually quite like Dan Murphy's and the pub group itself. Pretty good businesses. They grow reasonably well. Whether Endeavour Drinks can grow much faster than what it is doing today, I doubt it. But maybe on the hotel side, you could probably grow it a bit quicker. Yeah. We actually quite like the spin out of Endeavour Drinks.
Okay. Adam, Endeavour, if you had a thought about it, and go on to a next question I had following on from that, is you used to really just look at consumer sentiment and those sort of things when you're sort of thinking where these businesses are going. But now, is there something you sort of call out that you think has a big impact on these companies, like one single factor?
I think it still is the health of the consumer, definitely. When you're looking at Woolies versus Wesfarmers and Bunnings, I think Woolworths is more defensive if things get really bad. We all still have to eat, we don't have to paint our house. And so I think in a downturn, Woolworths will probably hold up a little bit better. But for the long term, I think Endeavour, it gives shareholders the option of investing in the gaming and alcohol business versus the supermarket business. And I think that's a great way to go, giving investors the choice and by demerging it.
Let them choose what they want to do. And Vince, a single factor, is it still consumer sentiment? Is that the one for you? Or is there something else that you sort of think about there?
I think you've got to also bring into that just any structural issues that, everyone's talking about Amazon coming into supermarket retailing or retailing in general. I think that's consumer sentiment will go with GDP and a little bit more, etc. Moving around with that. But if the industry structure is not right, that far outweighs any consumer sentiment issue. And I think actually in retailing, I think it's gotten a bit better now that Coles has been spun out because has got a big group behind it to sort of support it as it earn its own returns.
Yeah.
Yeah.
Okay. All right. So if you had to pick one, let's see what you think going forward. Which is the one you prefer, and maybe if you could just give us a couple of quick reasons why.
It is at this stage, particularly where we are in the lateness of the cycle. It is Woolworths for that reason. They've basically done everything they've said they would do 3 years ago, reinvested back in the core. It's a high returning business, supermarkets for them, and divesting. The petrol business has been divested. They're getting rid of Endeavour drinks, etc. So we're getting a lot of capital back, and all indications from management is that they're going to reinvest back into the business, whether it's online, on retailing, etc. So to defend the core, I think, as Adam mentioned, it's a bit lower risk. And I think at this point in the cycle, probably stacks up a little bit better for us.
Okay, Adam. Woolworths, Wesfarmers, which is your pick?
Yeah, I'm going to have to disagree here and go with Wesfarmers. I think the core of that business is Bunnings. They are moving into the trade where they haven't really participated and tried to grow in the past. They've got the online piece, they're just starting to roll out. That'll give them some extra growth. And then at the corporate level, the strong balance sheet and the ability of that management team to invest that capital, they have done well in the past. We think that can provide some sort of long-term value accretion. And third point, it is slightly cheaper. So maybe 1 or 2 PE points under and a 4% yield versus Woolies on about 3. So we'll go with Wesfarmers.
Okay. Well, the prices aren't down, but these stocks are still well worth having a look at.